Okay, so quick economic update, market commentary. This has been just kind of heavy on my heart and mind. I just feel like we need to be out there in front of you and be maybe a voice of reason. If you watch television and all the men wearing makeup on TV scaring you to death, it's real cause for concern when you think about your life savings being at the mercy of capital markets right now. So here's the most important slide. Keeps me in good graces with Paige. This is our compliance side, so really take that in. Okay, moving right along. Okay, so it just seem like the list of economic headwinds right now is just longer than it's ever been before. I know things have kind of settled down in Ukraine to a certain degree, but they are still very much locking horns in the midst of a very ugly geopolitical war. Inflation, we're seeing numbers comparable to that of the late 1970s, early 1980s. We're cruising. The February number was at 7.9% with inflation. Gasoline prices, I'm not the type of person who reads menus right to left or drives 2 extra miles to save 5 cents on gas, but I'm starting to become that way. When I fill up my cart at the grocery store or I fill up my gas tank, it's alarming. So that's going to be a boon on the economy. COVID-19, they're actually shutting down areas of China, manufacturing areas of China because of a new COVID variant. So unfortunately, that narrative hasn't completely gone away. And then, of course, the Federal Reserve has announced that they're going to be getting together another 4 or 5 times before the end of the year. And many people are saying that they're going to be raising interest rates each one of their visits. They just had a little quarter-point interest rate increase. So, of course, that's going to have near-term effects on the stock market. So, not as to sit here and scare you doom and gloom for an hour. I want to maybe be a beacon of hope in all of these nasty economic headwinds, because it's not all bad. There is some good news that's out there. In fact, GDP in 2021 was 5.6%. That's the best it's ever been since 1984. And that's growth minus inflation. So we had an incredibly good year for gross domestic product and production in 2021. Unemployment is back to where it was pre-pandemic, right? We had an unemployment reading of 3.8%. So when the American consumer is back to work and making a paycheck every 2 weeks, they're going to be spending money. And 70% of the American economy is driven by the American consumer spending patterns. So that's an encouraging number when you look at how low unemployment is right now. The supply chain, this is an interesting chart. This shows how many days at anchor boats are parked outside of the LA port, which is the busiest port in the entire world. So you can see this red trend. It's almost back to where it was before the pandemic. So that tells us that the supply chains should start to sort themselves out. So when you go to the grocery store, you're not going to see vacuous shelves. And when you go to a fast food place, they're not going to say we don't have any lids for the cups. So that's a good news for the supply chain when you see boats not nearly parked at sea for as much as 30 days at the worst of it. The housing market is on absolute fire. I know some of you have sold your house recently. Some of you have neighbors that have sold your house recently. I know some of you get on Zillow right before you go to bed just to see how wealthy you are due to the equity that you have in your house. This is the supply of new houses in this country. It's never been lower than it is right this very minute. And heck, South Carolina, this is for the whole United States of America. South Carolina has an even lower supply than the rest of the country. That's why everywhere you look, every postage stamp piece of dirt, there's a house getting thrown up on side of it. The laws of supply and demand supersede and trump interest rates or monetary policy. If people need places to live and the supply has never been lower, literally in the last 40 years, naturally, that's going to be a good thing for housing prices. And typically, the American consumer, when their house's equity or their home's value goes up, that typically gives them a comfort and a peace of mind knowing that they could spend more money And as Americans, that's what we do. We spend money, and again, it fuels 70% of our GDP. All right, so consumers have a war chest of cash, mainly because of M2 monetary supply. The CARES Act, which took effect back in 2020, everyone got those little $1,200 stimulus checks, and then they did the AR, American Relief Plan. That was another act. Right now, American consumers' savings rate has never been higher. I know sometimes we listen to Dave Ramsey and we hear about all the people who are riddled with debt, and we talk to our grandkids and our children and we go, boy, you haven't learned anything about personal finance and you're not frugal. The fact is the mathematics surrounding American savings rates right now, because wages are up and because a lot of people no longer have to commute to work because they're working from home or moving to parts of the country that have lower living costs, like people from the cities. People are saving money at a higher clip than they ever have historically. In fact, there's $2.4 trillion of cash on the sidelines. So that is a good thing for the stock market. Interest rates, I know people are worried about interest rates because by and large, as interest rates increase, it's a negative thing from a short-term perspective on the stock market. Typically, as the Federal Reserve raises interest rates, stocks crash. But on a medium term or a long term, there is countless amounts of periods of time in which the Federal Reserve has increased interest rates, and it has been a good thing for the stock market. Generally, as interest rates go up, the stock market will also go up. And that's because our Federal Reserve, I don't know if you've noticed over the last 5 years, they're pretty squeamish. Like anytime the market does a little head fake, they're very quick to come to the rescue with stimulus or money printing or monetary supply manipulation or interest rate fluctuations. So as interest rates go up, that should actually be a good thing for a stock market. I bet y'all didn't think I was going to say all this good stuff when I started the presentation. What about Ukraine, though, Adam? This is unprecedented. We've never seen anything quite like this. It might be a nuclear war. Well, this is the S&P 500 dating back to 1928, and all of these little comment things are various wars. So you had World War II and Vietnam and the Iraq War and Afghanistan and the Syrian Civil War and the Arab-Israeli War. And the S&P 500 has absolutely shook off all of these major geopolitical events, which I can assure you, when we were in the midst of them, we thought the sun wasn't going to rise the next day, and the world was betting on the end of the world was probably a reasonable wager in the heart of some of these major events, especially if you were actually on the ground in those theaters. So the S&P 500 has shown a knack for shaking off major geopolitical events. But here's where the presentation takes a left turn. Just showed you about 5 slides to be optimistic about. Reasons to be optimistic. The supply chain and GDP is good and people got cash. What scares me more than any other economic indicator out there is the inflation rate, right? Inflation ultimately is not necessarily a terrible thing for many of you watching this webinar right now because you own your homes outright. You have hundreds of thousands or millions of dollars of assets sitting in IRAs and non-qualified brokerage accounts or metals and masterpieces and mansions. You own assets, so by and large, inflation is a good thing for people who own assets. But remember, we talked about 70% of the American economy being driven by the spending patterns of the middle class. When you look at a household right now that might have a household income of 60 grand or 100 grand, after FICA taxes, after you make a little contribution to your 401k, how much money is actually hitting your bank account? Then you look at housing prices never being higher, rents and real estate sale prices. Food prices have never been higher. There's going to be food shortages, is what Joe Biden said in one of his most recent talks. Gasoline prices have never been higher. Eventually, you reach a boiling point where a dollar can only go so far. And if I'm experiencing it, someone who doesn't read menus left to right, I can only imagine someone fresh out of college with that first gig and they're trying to make a rent payment and trying to buy a new car. Or God forbid, if you've got 2.5 kids and one of them's a senior in college and one of them's a freshman in college and you got to gas up the minivan. So inflation is going to be an absolute boon on the economy. And you're going to see something in a little bit that is going to bake in how they see inflation having effects on the stock market. The other thing I'll say about inflation is nothing exacerbates and compounds civil unrest quite like inflation. If you all remember the Arab Spring, the reason the Arab Spring occurred was because of food prices. Food prices grew out of control and people took to the street with pitchforks. And if we've learned anything from the George Floyd riots or the January 6th insurrection, it seems as though because of social media and partisanship, rioting and protesting, like the veil of civility that we have amongst us and throughout society, we are very close to having these major boiling over events with riots and protests. I would be worried about inflation because when you look at the circumstances surrounding George Floyd and police brutality, or the January 6th insurrection where people were questioning the results of the election, no doubt those were big things to be riled up about. But when people are having trouble feeding their families and fueling their cars and maintaining the shelter above their heads, that will bring out a side of humanity that I don't want to bear witness to. So inflation is a terrifying number for me. I do not think it's transitory, because was it transitory when we increased M2 monetary supply by 40%? No, we did not. So they need to raise interest rates a heck of a lot faster. I don't think there is the gall at the Federal Reserve. I don't think Jerome Powell is Paul Volcker. I don't think he has the wherewithal or the spine to do the tough things that need to be done. He's worried about the housing market crashing because interest rates go up a tick or two. I just showed you the supply of housing, right? Do you think if a mortgage goes up 25 basis points or a mortgage goes up 1%, people are going to stop buying houses? I don't think so. But those are the type of gutsy decisions that need to be made in order to quell this inflation trend. So there you go. I gave you 6 slides that might leave you a little bit encouraged. Then this one came. This is a terrifying trend that's occurring. Now, in our defense, not that we need to be defended, we did a whole presentation on inflation last June, or I think it was March or June. We made very thoughtful adjustments. If you work with us, we made very thoughtful adjustments to your portfolios last year as to anticipate what was going to happen with inflation. And you all have benefited from that. In fact, we ramped up our, we whittled down on our bond holdings, which we've been doing for the last few years. We increased our holdings in things like Treasury inflation protected securities. So again, folks like yourself who have hundreds of thousands of dollars, millions of dollars, you own your homes, you have assets, you'll be okay. You'll be the benefactors of inflation. But I think of your children. I think of your children's children. We're ushering in an entire generation of individuals who will not own assets. How are you to have hope in the American dream if you can't get in on a darn house because prices are so high and you can't set aside enough of your paycheck on a biweekly basis to accumulate some wealth to get a taste of the American dream? Okay. So there's 2 things I read each and every year. I think that they are probably the most important things for individuals to read. And this one's it's easy to read. It's like a 5-pager. One is Warren Buffett's white white paper or his letter to his shareholders. I think I've been reading that since I've been like 15 years old. He's just an excellent orator, and little quips in there. You see who's swimming naked when the tide goes out. All of his awesome quotes are in those white papers, so that's a must read. And the other thing I read every year is Vanguard's Market Perspectives piece. They release it every year, and in it they do a 10-year analysis of where they see the various segments of the market, their annual rate of return projections. And the Market Perspective piece that they released in March was the most bearish 10-year projection Vanguard has ever made. They've never been this bearish. And Vanguard is a permanent bull of the market. If you've ever listened to John Bogle or people who call themselves Bogleheads, what they believe is you should put all your money in Vanguard index funds, hang on for dear life, pay as little in fees as humanly possible, because the stock market goes up to the tune of 7 and 9% per year. And all you need to do is have ice water in your veins, hang on to your seat, buy index funds, and you will be rewarded for having some stick-to-itiveness and some ice water in your veins. Well, here's Vanguard now projecting U.S. equities over the course of the next 10 years to only increase to the tune of 2 to 4% per year. Now, value stocks, these are dividend-producing stocks, 2.8 to about 4.8. Our dividend driver model has a yield of about 4.8. I think it's 4.6 the last time I looked at it. So you can get dividends that yield 4.6%. U.S. growth stocks. This is what's been leading the charge over the last 10 years, right? Growth stocks. Amazon, Netflix, Apple, Google, Facebook, the FANG stocks. Vanguard's projecting them to have a negative rate of return over the next 10 years. Not only did Vanguard come out here and say this, Schwab said it, Fidelity said it, JP Morgan said it. All of the big asset managers are releasing their forecasted rate of returns to the market, and they've never been more bearish. I'm not going to take these numbers because economists are like weathermen, like they're right 30% of the time. And then they usually hedge by saying, 30% chance we're going to fall into a recession, 30% chance of rain. That way, if we fall into a recession or there's rain, they can say, see, I told you so. But I think the overarching theme with all of these projections are you should not expect from equities and index funds the same rate of return that you've grown accustomed to the last 10 or 20 years. And it's because of inflation. They also reference interest rates. They also reference COVID. They also reference geopolitical events. Although it's worth noting, they are more bullish for global equities. You can see 5 to 7%. Take a look at this. Here's their forecast on bonds, right? Projected rate of return for U.S. aggregate bond index, 1.5% to 2.5%. They project inflation to only be about 1.6 to 2.6. I guess that's somewhat encouraging, but if you park your money in bonds, you'll be losing money safely. Heck, even if you park your money in U.S. equities, you might be losing money safely if we have a projection of inflation at about 2.6%. Down here, I put a little chart of the 10-year Treasury. We talk about the Treasury on these webinars probably more than we talk about the stock market. If the stock market were to go up 92% in a 6-month time period, there would be a parade on the street and all the politicians would go out there claiming that they're the cause for it. When it happens to the 10-year Treasury, no one really even bats an eyelash other than the fact that they see their mortgage rates go up. We've seen the 10-year Treasury nearly double in the last 6 months. It's now teetering around 2.3%. As interest rates go up, bond prices go down, although newly issued bonds will actually offer higher yields. So if you are a bond investor, you have lots of money in bonds, this Treasury yield increase is a bad thing for you. So many people are calling now for the death of the 60-40 model. Now, to be fair, my entire career, which is now darn near 20 years, people have been calling for the death of the 60-40 model my entire life. It seems to have a heck of a lot more reverence now. When you see the Treasury yielding 2.3%, the Federal Reserve coming out saying they're going to be increasing interest rates 5 more times this year, when Vanguard projects equities to only make a 2 to 4% rate of return, in bonds 1.5 to 2.5%. So if you have a 60-40 blend, and then you're paying a financial advisor a fee, and inflation's running 2 to 3%, is that a winning proposition? When I look at these rates of return, I say to myself, why on earth would I subject myself to the EKG of the stock market in the name of making 2 to 3% in U.S. equities? Why would I put my money in bonds that have a projected rate of return of 1 to 2% when the Federal Reserve is going to be raising interest rates and inflation's running 2%? So I happen to agree that the 60-40 model is not going to be nearly as fortuitous as it once was, because rising interest rates, lower bond yields, a stock market that's at an all-time high, there's less growth prospects baked into it. And if you work with us, you haven't subscribed to the 60-40 model forever. I mean, I've been very, we've never liked the 60-40 model. The 40% bond component, we've always used alternative investments. That's what this Kiplinger article is talking about. The 60-40 model no longer lives. Now it's 33, 33, 33. 33% equities, 33% bonds, 33% alternative investments. And that's what we subscribe to here as a firm. So what do we do when there's a fork in the road? Take it. Who said that one? Yogi Berra or something like that. What do we like as a firm? Okay. High quality, cash heavy companies that are capable of paying us dividends. We love dividends. You've already witnessed us make a major shift internally within your accounts to have a heavier emphasis on dividends. And if you want to go over that with us, please lean into our office. Even if you just schedule a 15-minute call and say, Adam, I watched the webinar. I want you to point me in the right direction so I can fix my eye on these dividends you talk about. Now, this somewhat sounds a little bit counterintuitive, because I said they're capable of paying dividends or they're capable of doing stock buybacks, right? Basically, we're looking for companies that are generating lots of cash. Now, what they do with that cash, they either better pay me a dividend as a shareholder, or they better buy more stock. One of the number one performing stocks in the S&P over the last decade is AutoZone. AutoZone is up 27,000%. How many of y'all stepped into an AutoZone over the last few years and said, boy, this must be a really well-performing stock? Every time I go into an AutoZone, it takes me 30 minutes before someone helps me, and it smells like tires in there. But that stock is up 27,000%. And the reason it's up so much is because they have been prolific buybackers of their stock, if that's a word. They've been taking all this cash they've been generating and buying more of their stock. What we don't want to see is companies sitting on hordes and hordes of cash. If they're sitting on hordes of cash, they better be buying more of their stock, or they better be paying me out via dividends. Fixed accounts, building short-term ladders with fixed accounts. So when I talk about a fixed account, I'd want to keep my holding period 5 years and lower. That's what I look at as a short term, and preferably even shorter if possible. Now, a bond is not a fixed account, because a bond, if interest rates go up, the bond price will go down. I'm looking for fixed accounts that give me some level of interest rate risk protection, meaning a CD. Now, I would not recommend CDs. I'm going to show you in a second. There are alternatives to CDs. But a CD, you know with certainty, you put money in a CD, your principal is not going to gyrate based on interest rate fluctuations. You are going to get a fixed rate of return, and at the end of that term, 1 year, 3 year, 5 year, you're going to get those interest payments along the way, and you're going to get your principal back. So fixed accounts are not bonds. I'm going to elaborate that on a second. Fixed indexed accounts, fixed indexed annuities, the A word. I know some people shy away from that word, but honestly, when I look at equity prices only increasing at 2 to 4%, and I could make potentially 2 to 4% and take zero risk, why would I subject myself to risk? The cost benefit or the risk benefit doesn't make any sense. Warren Buffett's iconic quote, why take risk with money to buy things you don't need? I just butchered that. But the premise of it is, if you could make a comparable rate of return without subjecting yourself to a volatile market, why on earth wouldn't you consider doing that? Other linked accounts, Treasury inflation protected securities, I bonds. I did a whole podcast on I bonds and Treasury inflation protected securities. Been getting lots of client calls saying, hey, what do you think about these I bonds? We love them. In fact, your portfolio probably has a major component of I bonds within it. So lean into our office. Let us show you the adjustments that we've been making within your account. Let us show you ways that we're positioning you to get the better end of inflation. Again, Dividend made that adjustment. Active management. Finally, active managers are getting their light their day in the sunlight. Passive management has been ruling the day over the last decade. The Wall Street bets crowd, the AMC bros have been talking about just put all your money in a Vanguard fund. For the first time in many, many years, active managers are outperforming passive managers. And that's the case like with our Swan Model, which is an actively managed portfolio. When you see the stock market start the year off down darn near 15, 20%, depending if you're looking at the S&P 500 or the NASDAQ, and you have an active manager that's actively making adjustments and pulling you out of harm's way, that's been a thoughtful way to invest in the market year to date. Stocks that perform well in rising rising rates, well, that's technology stocks. Now, again, I said a couple slides ago that growth stocks are projected to have a lower rate of return. And I think sometimes people think that growth stocks and technology stocks are synonymous. And that certainly was the case throughout the 90s and the 2000s, and heck, maybe even up to the last few, this past decade. Let me ask you a question. If you have an iPhone and you were to drop it in a pail of water, what are you doing? You're going to the Apple store and getting another iPhone. Or if you go online, or if we fall into a nasty recession, are you going to stop searching for things on Google? Or are you going to stop buying things on Amazon, even though they're going to be delivered to your door for a cheaper price than what it's going to cost you to go to a grocery store? So this idea that technology stocks are only growth stocks, I think that trend is changing. Technology companies have become consumer staples companies. They become blue chip stocks. We cannot live without many of these technology names. So no longer are technology names going to purely be growth names. I saw the other day that Facebook has more users than Christianity. At what point do we stop calling Facebook a growth company when they have more users than Christianity? Eventually you reach a point where you go, okay, and it seems like some of the people at Facebook ought to use a little Christianity, because I won't go into that, but they could probably use a little dose of Christ with some of the things that they're doing right now. But at what point are your number of users at a level where they can no longer exponentially grow and grow and grow? I think there's like 1 billion iPhones out there, right? So I think there's going to be a trend over the course of the next decade where we no longer view technology companies purely as growth plays. Technology companies are going to be the AT&T and ExxonMobil of the next decade, perhaps, especially if they start paying us dividends, which undoubtedly they're going to have to. Apple is already paying us dividends. So technology stocks tend to do well in a rising interest rate environment. And the reason being is because they have very little reliance on debt. You look at a company like Google, like it's basically a big server underground that they keep cool with aquifers. They flick a switch and the engines are working. It's not something that requires a tremendous amount of input raw material. It's not something that needs a tremendous amount of manpower to do deliverables or supply chain routes. So those types of companies should do well in a rising interest rate environment. And we like all of the things that you see on the screen right now. I thought this was an interesting tweet. Frank sent me this. It's from Lizanne Saunders. A couple days ago marked the 2-year anniversary of the coronavirus bottom, when you remember the market dropped 35% in a 21-day trading period. A couple years ago, that was the anniversary, March 23rd. And since then, the S&P 500 is up 99%, whereas the bond aggregate has fallen 2%. So I thought that was just an interesting thing. Here again, not to take a victory lap, but if you work with our company in the heart of coronavirus, what we wanted to do was whittle down on bonds, especially as we started to see the stimulus start to take root and all the money getting printed. Whittle down on bonds, own dividend stocks, own alternatives to bonds. Because as interest rates go up, bonds are going to have a very, very difficult time returning any yield. All right, what's an alternative to a bond? Consider a fixed annuity. Remember we talked about fixed accounts. Right now, I just looked at NerdWallet and Bankrate for CD rates. The best 5-year CD I was able to find was paying 1.5% per year. Okay, lock up your money for 5 years, make 1.5% per year. Here's fixed annuity rates. Here's a 2-year, 2.1. Here's a 5-year, 3.25. Here's a 3-year, 2.7%. These are not subjected to interest rate fluctuations, right? You put your money in the account, you get principal protection, you get a compounded, guaranteed annual rate of return that gets paid to you like clockwork. And at the end of 2 years or 3 years or 5 years, you can take all your money and your interest and go someplace else. You can also structure them to pay the interest to you. So if you're someone who's very squeamish about taking market risk and you're more of a CD investor, but you don't like what the banks are offering you right about now, consider looking at the dreaded A word. Now, there's a whole different legal reserve system that backs these up. So we'd want to do business with A-rated companies. We'd want to make sure we put the proper dollar amount in these so we don't supersede, reserve requirements and such. But these are a viable option in lieu of bonds, right? Why would I buy a bond over the last 2 years? Lost money. You're down 2% over the last 2 years in a market period where the market's been doing phenomenally well. Whereas if you put it in a boring little fixed annuity, at least your money's up 5%. Something to consider. I don't think I've ever done a webinar where I've said the annuity word as much as I have than I have today. And I'm going to continue saying it because another option are fixed indexed annuities. Okay. This is a chart that's comparing the S&P 500. There's a red line. You can see it just shot through the roof ever since we started printing money like crazy. And then you've got a fixed rate of return, which is like this blue line. And then the green line is a fixed indexed annuity with a 40% participation rate. So basically, if the market goes up 10, you make 4. If the market goes up 80 or 20, you make 8. You get a portion of the market's upside, and you get that portion because if the market crashes, your principal is protected and all of your previous year's gains are also protected. I've already mentioned this. When I look at Vanguard's 10-year forecast, U.S. equities, 2 to 4%, why would I subject myself to a tremendous amount of risk when I can plop the money in a boring account that's going to give me a portion of the upside and none of the market's downside and make a comparable rate of return? This is another viable option for individuals who have bonds. It's another viable option for people who are looking at some of those economic headwinds and going, I'd like to de-risk a little bit. Fixed indexed annuities, I bonds, market linked CDs all fall into this very same category. Let's talk about dividend stocks. Gosh, I've reused this slide 4 different ways, but I'm a broken record. This is Johnson & Johnson. Now, we're not making a statement about Johnson & Johnson because I know they could be a little bit controversial with vaccines and such, but it's a company that we all know and has been around forever. Take a look at this EKG of Johnson & Johnson. This is just a 2-year period, down 7%, up 15%, down 21%, down 10%, down 11%. If you were to put hundreds of thousands of dollars inside Johnson & Johnson, you would literally see your $100,000 increase and decrease tens of thousands of dollars in a 12-month period. So it's not for the faint of heart, dividend investing. But when you invest in dividend stocks, you're less focused on what are called your paper gains and losses, and you're more focused on these little D's I circled down here. You are getting a consistent, predictable dividend each and every quarter. So dividend investing, especially if you can find yourself dividends that are yielding 4+%, seems to be a winning proposition to combat inflation. because not only do you get a yield of 4%, in theory, if you do a good job of building a portfolio, which I'm going to show you in a second, what Johnson & Johnson has done, if you look at it under a microscope, it looks like an EKG. But if you squint your eyes and you take a step back, it looks like a 45-degree angle. Most dividend stocks will show this very trend. If you look at them closely, there's a lot of chop. But if you scan out and you look at the trajectory of that stock over a long period of time, you're going to get a dividend like clockwork each and every quarter or each and every year. And then you're going to see your purchasing power or your principal increase as money circulates through the system, and the geniuses over there at Johnson & Johnson figure out ways to separate us from our money when we go to the grocery store. All right, so we built a model. We call it our dividend driver model. And what we're trying to do here, you can find stocks that pay tremendously high dividends. AT&T, for instance, I just looked at it, pays a 9% dividend, right? So some people go, give me the one with the highest dividend. Have you looked at a chart for AT&T stock as of late? It has been a dying dog with fleas. It is a terrible stock, but you make your 9% dividend. So what we're trying to build here is a balance between a strong yield along with a portfolio that has growth potential over time. So we sprinkle in here master limited partnerships, energy and infrastructure pays a huge dividend at about 11%. You'll see international dividends, dividend aristocrats, companies that have shown a consistent ability to increase their dividend for 25 years in a row. We even got some treasury inflation protected securities in there. We've got stocks that not only pay a dividend, but also have a growth prospect to them, like companies like Apple, for instance, high yield bonds. So for the individuals who scoff at the idea of putting their money in a fixed annuity or a fixed indexed annuity because you're more market driven, I would tell you to have a heavier emphasis on dividend stocks. Lean into our office, ask us about our dividend driver model, or build your own dividend driver model if you don't work with us and you're a do-it-yourselfer. But keep in mind, dividend investing is not about getting the stock with the highest dividend only. You need to have a quality company. I might also argue, if AT&T is distributing 9% of their cash to their their stockholders, how on earth is that company supposed to grow? Amazon operates with a profit margin of 1. Literally, for every $100 that comes in, $99 goes back into the business. Only $1 goes towards profits. So if AT&T is giving 9% of their cash away to their shareholders, it's kind of, you're chopping your nose off to spite your face. Businesses grow by making investments within their, R&D or their workforce, or I don't know, building a new mousetrap or bidding a new office or something. So you need to be careful about purely looking at stocks that pay huge dividends. You also need to own businesses that are well run. Here's our Swan model. Again, I think that it's been, I have a love-hate relationship with our Swan model. I loved it back in January when all the triggers were going off and we were quickly and thoughtfully pulling our clients out of harm's way as resistance levels have broken through and the algorithm was telling us to get the heck out of harm's way. I think some of the trades out of the market were very thoughtful and very timely. But then I hate it because there's so much activity in it. Like just this past week, we bought into a number of the sectors within the market. And I can't tell you if we break trend again. We have a saying around here in the office, trust the algorithm. Sometimes we want to wet our finger and go, well, Jim Cramer told me to do this. Well, stay out of your own way. Let the algorithm do what it's supposed to do. It's been doing a wonderful job of giving our clients peace of mind in that when everyone runs for the exit, I'm never going to be there to tell you, hang in there, Tom and Mary. The market always goes up. It'll come back. Lincoln came back as a penny. We want to make sure that the individuals that we get to work with, retirees, are not riding the roller coaster all the way down to the bottom. People hire us to help protect their life savings, to smooth out the ride. Our Swan model has done a very good job of doing that. So another option, if you think we're in for a bumpy, choppy next future because interest rates increasing and all the other things that I listed as economic headwinds. All right, in summary, you know how I like to do this if you've witnessed one of these webinars before. This is my little girl, Mary Kate. And does that look like the face of a bear market? Her entire life has been spent with the stock market down in value, and it's just not right. So, do you think really that her entire life will be spent with a down market? I sure hope not. That would be an awfully depressing existence, and it probably wouldn't be good for her daddy's company and his existence either. So anyways, we like to just kind of shine a light on what's going on with us behind the scenes. Baby Mary Kate just turned 4 months old, and her entire life, the stock market is down. Hopefully we get a little rally here. It seems like the market's poised to increase, and maybe eventually the numbers will be green for her existence here in short order. Finally, please don't keep us a secret. For the folks who work with us, lean into our office when the market's ugly and choppy and all the people on TV are scaring you. That's when we want to work twice as hard. That's when we earn our keep. We don't want to be the financial advisor on the golf course or hiding under his desk. We want to be the people who are out there distributing pertinent content and thoughtful content. And we also want to be the people who are going over your plans with you. The greatest compliment you can pay us is by sharing our name with friends and family. The people in our client service department came up with this awesome idea. They basically said, hey, why don't we give the books as gifts addressed by the client, right? So if you have any people in your life that you think would benefit by letting us bend their ear, please share this webinar. We're going to be distributing it via YouTube, so you can just send it via email or post it on Facebook. Or if you give us their name and number or their name and address, we'll send a book to them, but it won't smell like it came from us. It'll basically just go, hey, these are the people who helped me with my money. Maybe this book is of use to you. And who knows, maybe they're a do-it-yourselfer, or maybe they're financial advisors, their golfing buddy. There is zero pressure involved in this, but we want to get our name out there and get in the ears of as many humans as possible. And typically the people that we want to work with are similar to you, right? The people that you rub shoulders with usually have a similar, economic footprint and similar beliefs of the world. So please don't keep us a secret. Reach out to our office and let us send a book to people that you like, and trust. Y'all, thank you so much for putting a little faith and trust in my company. If there's anything we talked about during this presentation and you want the presentation to look at some of the charts, we're happy to distribute that. And like I said, we're probably going to try to get this out via YouTube as well. Thank you all so much. Any questions in the group? I'm happy to address some questions. Should we be buying gold and silver? Great question. Hey, gold is always looked at as a flight to safety. And gold salesmen are very predictable, right? They will always bet on the end of the world. Do me a favor when we hang up from this. Take a look at the chart for gold in the year 2021, a year in which the market did phenomenally well. Gold was down in value in 2021. Okay. Now, this is not to say I don't believe in gold. Our portfolios right now have a heavy reliance on gold because it acts as a hedge. And when that Swan model triggers out, we shift money into gold. But at the end of the day, gold, the old playbook on inflation was buy metals, masterpieces, and mansions. That trend did not materialize in 2021. Now, granted, in 2022, we've seen gold tick up a little bit and silver tick up a little bit. However, gold was not the ultimate inflation hedge in 2021 like the textbooks are teaching us when you get a degree in finance. My problem with gold is it's a stagnant asset, right? All of the world's gold would fit in an Olympic-sized swimming pool, but guess what it would do in there? It would just glisten and look pretty. Wouldn't it pay you a dividend? Wouldn't it pay you rent? Wouldn't it pay you any interest? So when you listen to gold salesmen, they are regularly, or Glenn Beck, I know, is getting a lot of fanfare right now because of the Great Reset and ESG investing and things like that. I did a podcast on that if you want me to elaborate on that. But Glenn Beck's number two biggest advertisers over the last decade, he's a bit of an economic grifter. He's always betting on the end of the world, and betting on the end of the world is very rarely a profitable bet. It's food storage and gold, right? Had this company had a heavy reliance on gold over the last decade, I can assure you we wouldn't have the success that we've had. Now, do we completely dispel gold like it's a terrible investment? No. But it only belongs, in my opinion, 3 to 5% of your portfolio, maybe upwards to 10 if we're truly in a really gut check moment and you've made some thoughtful adjustments within your portfolio. But if you think we're going to revert back to this dystopian world where everyone walks around with satchels of gold like Robin Hood, I think you'd be better off buying guns and ammo. Okay. Send out the replay information. Okay. Let me see if I got any other quick questions here. Show the 5-year graph of what? I don't know what that is. I can get you that. MLPX in your dividend driver is MLPX is in the dividend driver model. Good picking up on that. Is your audio back? Is your audio working? Oh, please don't tell me the audio was jacked up. This seems to happen with lots of people. Need some purple streaks. Okay, I think that's Mark making fun of my hair. All right, y'all. Thank you so much for tuning in. I appreciate it. And lean into my office. Thanks for the webinar. I'm not seeing the question. Should I be? Now, there's just a comment section, a chat area where some people ask some questions. And honestly, if there's something that you want me to elaborate on, we can do a podcast or maybe even do another one of these webinars. Y'all, thank you. Thanks for tuning in.